Let's first look at the fair value method. And here there are four major events I want to talk about. The first event is when investor makes the initial investment in the investee. And then the second major event is when investee declares dividend. The third major event is when investor receives the dividend from the investee. And then the last major event is, what if at the end of the financial reporting period, there's a change in the fair value of the investee? So the questions for accountants are, what do we do under each of those situations? Specifically, what journal entries we make. The journal entry for the first one, the initial investment, when investor makes an investment in the investee, what is the journal entry for the investor? For the investor, it gave out cash to invest in the investee, so it credited cash. And at the same time, this is viewed as an investment for itself, so it is increasing its asset with debit investment account. For the second major event, when investee declares dividend, what is the journal entry for investor? From the investor's perspective, it is viewing it as a dividend receivable, so it is going to receive dividend from its investee. At the same time, because we're using the fair value method here, so this is viewed as a dividend income for the investor. So we credit dividend income. And then the third major event, when investee pays out dividend to the investor. And here, because the investor has received the dividend now in cash, so we debit cash, and then it is no longer a receivable for the investor, so we credit dividend receivable. Dividend receivable goes down. The third major event, what if there's a change in fair value of the investee at the end of the financial reporting period? And here, we either, depending on whether there is an increase in fair value or decrease in fair value, we either debit or credit unrealized holding gain or loss. And then at the same time, we credit or debit the fair value adjustment account. Let's look at an example here. On December 15th, 2015, Company A purchased 100 shares of Company B stock for 45 per share and used the fair value method to account for the investment. On December 20th, 2015, Company B declares a common stock dividend of $1 per share that is payable on January 20th, 2016. And on December 31st, 2015, Company B stock trades at $50 per share. So we have two questions here. The first one is, how much investment income, if any, should Company A report for year 2015? And then the second question is, what relevant journal entries should Company A make in year 2015? So please take 5 minutes, try to work on those questions on your own, and then you can move on to look at my answer, the solution to this problem. Please take 5 minutes now. So you can, if you haven't finished, you can pause your video for now. And then I'm just going to go over the solution now. So first of all, what are the journal entries here? On December 15th, 2015, when Company A purchased 100 shares of Company B stock for $45 per share, the journal entry we make here from Company A's perspective, it is giving out cash of 45 per share multiplied by 100 shares. So that's 4.5 thousand. So the journal entry is to debit investment in Company B stock for 4.5 thousand, credit cash for 4.5 thousand. And then the second journal entry is when company B declares a common stock dividend on December 20th. So on December 20th, 2015, when company B declares common stock dividend, from company A's perspective, it is having dividend receivable now. At the same time, it is an income for itself. So we debit dividend receivable for 100. And this 100 is because of we have $1 dividend per share multiplied by 100 shares owned by company A. So that is 100. And we credit dividend income for company A, 100. And then on December 31st, that is at the end of the financial reporting period, now we need to look at the change in fair value in company B. Now company B stock trades at $50 per share. And then company A's initial investment is 4.5 thousand. And then at the end of the financial reporting period, it is the value of those investments, the fair value of those investments gets to be increased to 50 per share multiplied by 100 shares. So that's 5,000. So there's actually a $500 per, that is a 500 increase in the fair value. And then the journal entry we make here is to debit fair value adjustment for 500, credit unrealized holding gain for 500. So as you can see here that unrealized holding gain, the reason we're crediting it because it is a gain for company A. It is an increase in fair value. So it is viewed as an increase in income for company A. And then fair value adjustment, that is a balance sheet account. That is actually part of the investment account. Investment goes up by 500 as well. And then let's go back to the first question. How much investment income should company A report for the year 2015? And investment income includes both the dividend income, both the dividend income from company B and also unrealized holding gain, which is both this 100 and 500. So the total investment income is 600. So that is all you need to know from this course perspective about the fair value method. And then we're going to talk about the equity method.